Module 2, Information Processing. Unearned Revenue. Unearned revenues, also known as deferred revenues or deferred income, refer to a liability that arises when a company receives payment for goods or services that it has not yet delivered. In other words, it is an advance payment made by the customer for products or services the company still needs to provide. Unearned revenues are classified as a liability because the company is legally obligated to deliver the products or services the customer has paid for. The liability is settled in the future when the company provides the goods or services to the customer. For example, a company that provides subscription-based services may receive payment for an annual subscription up front. The company would recognize the payment as unearned revenue on its balance sheet since it has yet to provide the services to the customer. As the company provides the services for the year, it gradually recognizes the revenue on its income statement. Unearned revenues are essential for businesses as they can provide a significant source of cash flow. However, companies must carefully manage unearned revenues, as failure to deliver the goods or services promised can result in legal and reputational issues. It is also vital for companies to accurately account for unearned revenues to ensure that their financial statements are accurate and comply with accounting standards. A credit entry. The opposite of a credit entry is a debit entry, which records an increase in an asset or expense account and a decrease in liability, owner's equity, or revenue account. When a credit entry is made, it is typically used to record an increase in the funds a company owes to others, liabilities, the money it has invested in itself, owner's equity, or the revenue it has earned from its operations. Conversely, a credit entry would decrease the funds a company has invested in its assets or the expenses incurred in its operations. A credit entry would reduce the amount of cash or other assets the company has on hand and decrease the expenses it has incurred in running its business. For example, when a company sells a product on credit, it would record the sale as a credit entry in its revenue account as it has earned revenue from the sale. At the same time, it would record a credit entry in its accounts receivable account as it is owed payment for the sale. Likewise, when a company receives a loan from a bank, it records a credit entry in its liability account to reflect the increased debt owed to the bank. This entry would be balanced by a debit entry to the company's cash account to reflect the increased funds received from the bank. Example, telephone expense. The journal entry to record payment of a telephone bill would include a debit to the telephone expense account and a credit to the cash account. The debt to the telephone expense account would increase the expense amount, reflecting the telephone service cost. In contrast, the credit to the cash account would decrease the cash balance in the company's accounting records. The entry would look like this. Debit to telephone expense of $300. Credit to cash of $300. By making this journal entry, the company records the payment of its telephone bill and updates its accounts to reflect the decrease in cash and telephone expenses. This entry will be recorded in the company's general ledger and used to prepare financial statements at the end of the accounting period. It is important to note that this entry assumes that the company paid the total amount of the telephone bill immediately. If the company paid only a partial amount, the entry would reflect the partial payment, with the remaining bill balance recorded as a liability until it is paid in full. Additionally, if the company is on an accrual accounting system, the expense would be recognized when the service was provided, regardless of when the bill is paid. Opening a new business. When a new business is opened, a journal entry records the contribution of cash and other assets. For example, assume a contribution is $80,000 in cash and $20,000 in land. The journal entry to record this transaction would be debit to cash of $80,000. Debit to land of $20,000. Credit to capital of $100,000. The debit to the cash account reflects the increase in the business's cash balance, while the debit to the land account reflects the acquisition of the land asset. The credit to the capital account represents the increase in the owner's equity in the business due to the contribution of the assets. It is important to note that the capital account represents the amount of capital contributed by the owner or owners of the business. This account is reported on the balance sheet under the owner's equity section. The assets contributed by the owner are recorded on the balance sheet as assets, while the corresponding liability to the owner is recorded as the owner's equity. This journal entry would be recorded in the general ledger and used to prepare financial statements at the end of the accounting period. It is essential for businesses to accurately record these types of transactions to ensure that their financial statements are accurate and comply with accounting standards. Unearned revenue. Suppose a business receives cash from customers for products or services that still need the delivery. In that case, it should record the transaction as a liability until the products or services have been delivered to the customer. This is because the business must deliver the goods or services to the customer, and the cash received still needs to be earned revenue. To record this transaction, the business would credit an unearned revenue account and debit the cash account. The unearned revenue account is a liability account that represents the amount of cash received in advance for products or services that have not yet been provided to the customer. When the products or services are delivered, the business can recognize the revenue and reduce the liability in the unearned revenue account. The journal entry to record the receipt of cash from customers for products or services not yet delivered would be: debit to cash of X dollars. Credit to unearned revenue of the same X dollars, where X represents the amount of cash received from the customer. For example, if a business received a $1,000 in advance payment from a customer for a service that will be provided in the future, the business would record the transaction by crediting the unearned revenue account for $1,000 and debiting the cash account for $1,000. When the service is provided to the customer, the unearned revenue account will be debited for $1,000, and the revenue account will be credited for $1,000, reflecting the earning of the revenue. Debt ratio. The debt ratio is a financial ratio that measures the percentage of a company's assets financed by debt. It is calculated by dividing the company's total liabilities by its assets. The formula for calculating the debt ratio is: debt ratio equals total liabilities divided by total assets. The debt ratio is an essential measure of a company's financial health and risk because it indicates how much it relies on debt to finance its operations. A high debt ratio means that a significant portion of the company's assets are funded by debt, which could lead to financial instability if the company needs more cash flow to meet its debt obligations. Generally, a debt ratio of less than 0.5 is considered low, while a debt ratio greater than 0.5 is considered high. However, the optimal debt ratio will vary depending on the industry and the company's circumstances. Companies need to monitor their debt ratios and ensure that they maintain a level of debt that is sustainable and appropriate for their business operations. For example, assume total assets of a bakery are $425 million and the total liabilities are $110 million. Debt ratio equals $110 million divided by $425 million. This computes to 0.259. Therefore, the debt ratio for the bakery is 0.259 or 25.9%. This means that 25.9% of the company's total assets are financed by debt. Overstatement of account. An overstatement of an account refers to an error in accounting in which an account's balance is higher than it should be due to a mistake in recording or calculating transactions. It means that the financial statements or the ledger account have an amount higher than the actual value. Overstatement errors can occur in any account, such as revenue, expenses, assets, liabilities, and equity accounts. For example, a company may overstate its revenue if it records a sale that did not occur or includes revenue from a future period in the current period's financial statements. Overstatements can occur for various reasons, such as mathematical errors, incorrect data entry, improper accounting procedures, or fraud. They can significantly impact a company's financial statements and lead to correct decisions based on accurate information. To correct an overstatement error, the accounting department must identify the cause of the error and make the necessary adjustments to the account balance. This can involve making journal entries to correct the error and adjust the balance to the correct amount. The adjustment can result in a decrease in the account balance or a credit entry to the account. It is essential to promptly correct any overstatement errors to ensure that the company's financial statements are accurate and reliable. An accurate financial statement is essential for making informed business decisions, attracting investors, and complying with legal and regulatory requirements. For example, if a $15 credit to sales was posted as a $150 credit, the account was overstated by $135. This is because the correct amount to be credited to the sales account was $15, but instead, it was recorded as $150. To correct this error, a journal entry should be made to reverse the incorrect entry and record the correct amount. The journal entry to correct this error would be: debit to sales of $135. Credit to sales of $15. Credit to accounts receivable of $120. The debit to the sales account would reduce the overstated amount by $135, while the credit to the sales account would record the correct credit of $15. The credit to the accounts receivable account would reverse the incorrect entry when the credit was posted for $150 instead of $15. By correcting this entry, the sales account will be correctly reported in the financial statements, and the accounts will be accurate.